If you're trying to wrap your head around what's likely to happen with oil and natural gas futures in the near term and in the next few months, we've got your answers right here on the Energy Recon, and it starts right now. We're back.
Here we are in the Palatial Energy News TV.com studios.
This is nice.
How about that?
I like it. So it's Alan Lammy, and I'm Pat Fant. Here we are with the Energy Recon right here on Energy News TV, and we have got a lot to talk about today.
Energy Recon, you know what that means? It means that we are the proverbial ditch diggers of energy-related information, because you know why, Pat? We like to get down there, and we like to get dirty, and we like to find out the proverbial catalysts.
You should see where we go, where we have to go to get this information.
We are the honey badgers of energy-related insight and information. How's that?
Honey badgers of energy intel. So with all that set up, what's our news today? You've got a lot to talk about.
You know, we've got a lot to talk about. So we've seen oil prices, particularly WTI, West Texas Intermediate crude oil prices, that have seen quite a bit of little volatility over the course of this last few days of January. Here we are now in the first week of February, and you know, we've seen some big volatility in WTI. We've seen prices that have gone much higher than what some of the largest firms in the United States thought that they were going to do here now that we're in 2018.
If I remember right, Alan, you called this toward the, let's say, the fall of 2017.
You know what? Actually, even going back further than that, Pat.
Really?
Yeah, some of the shows that we did,
summertime,
early summer. Some of the shows that we did going back as far as May of 2017, we were calling for prices. We were calling the lows. We were calling the highs, and we basically said during that time period that oil prices were likely to run up toward $60 a barrel before the end of 2017, which they did in the last few days of December. Okay. Then once we got into December, actually before we got into to 2018, we were on one of our media radio partners, Mr. Lance Roberts, on the Lance Roberts Show, vocalizing on that show in the public that we were looking for $70 a barrel oil prices to happen, at least $70 a barrel oil prices to happen sometime within 2018, and boy howdy, have those prices really began to take off.
We're so close, we really are.
So what is, you know, first of all, where did oil prices kind of derail? Well, first of all, we have seen oil prices that have really been on a tear, obviously since the start of 2018. Like we always like to say, Pat, markets, you know, they don't go up forever. They don't go down forever. That's exactly right. That's right. So it was expected that prices had been so full of upside pressure that a little bit of that pressure steam had to kind of let off. Part of that catalyst, and a lot of people don't realize that over the last several years, we've actually seen a situation where there is, believe it or not, a correlation and coupling between the stock market, between the Dow Jones Industrial Average and the S&P 500, where anytime there are any big moves that occur in the equities markets, you will generally see that influence oil prices.
Sure.
Matter of fact, if you see a really large jaunt up to the upside in S&P 500, you're going to see oil move with it. But just like the other day, we saw the Dow Jones Industrial Average lose about 300 points.
Right.
Okay. Interestingly enough, leading up to and on the same day, I believe, of the President Trump State of the Union address.
Sure.
Okay. Of course, right after he comes back from that address, it's right back to the races again because of all the good economic outlooks that the president was addressing.
You know, economic news that you can't deny, you can't run away from.
Right.
You have to acknowledge that, yes, there are great increases not only in the amount of money that corporations are actually earning. Earnings are just great.
Oh, absolutely.
But the effect, the coming effect, not yet baked in really, of the tax reductions are just going to have tremendous upside.
There's already people starting to report on social media, such as Facebook and such, that they're already starting to see increases in their paychecks already.
Well, that's right. With February 1st happening, you're finally starting to see that money hit.
So let's kind of visit that here for just a moment because it all does directly relate to energy prices. It goes back to the core of discretionary income, okay? What is discretionary income? Well, discretionary income is that amount of money that you have left over after you've paid your bills, okay? If you have any. Well, up until now, we've seen a situation where there hasn't been a lot of folks out there that have a lot of discretionary income, but with these tax cuts, as we're already seeing, I'm sure a lot of people that you know on social media websites such as Facebook are saying, hey, I got an extra $150 during this pay period. That's discretionary income. That is now income that can be used at restaurants to go out to eat, at movies. It can be used toward more savings. It can be used to anything that you want to go out and purchase, which stimulates the economy.
And isn't that just really common sense?
Absolutely. But that increases demand for all kinds of items. When those and you would be absolutely shocked to know how many of the household items that you use every single day are related back to petroleum.
Of course. And derivatives in some kind from the manufacturing process, that the core product does start with a hydrocarbon somewhere.
Absolutely. So there's one catalyst right there, which is just a healthier economy type situation going on. But what is one of the other really big drivers that we have seen over just the last few days? Well, one of the big 500-pound gorillas that whenever they come into the market and make any kind of suggestion, the market responds, which is Goldman Sachs.
Sure.
Okay, Goldman Sachs came out just a few days ago basically saying that they were anticipating, and this, by the way, pay attention, this is the whole premise of the Energy Recon show, is to give you ideas as to where our oil prices are likely to head in the coming months. So Goldman Sachs just published that they believe that they will see Brent prices will hit $75 a barrel over the next 3 months, all right? 75 over the next 3 months, and they're anticipating that Brent oil prices will hit $82.50 over the next 6 months.
That's enormous, really.
So what does that mean for WTI? Well, okay, now Brent is obviously the European measurement of price for oil over in Europe. WTI is more oil based, but based in U.S. dollars. But what does it mean? What is it? Well, typically what we've been seeing, Pat, is about a $5 discount, okay, of WTI against Brent oil.
Against Brent, right.
So basically what that means is that if Goldman Sachs is correct and oil prices run up to the $75 a barrel area over the next 3 months, if there's a $5 discount, da-ding,
yes,
that puts our price target of what we've been talking about at $70 a barrel. Thank you very much, our studio audience, having a hand at that.
Right in the box here. That kind of works so good.
If the Goldman Sachs price forecast over the next 6 months, which they said is $82.50, applying that same logic of a $5 discount, that puts WTI prices at $77.50 per barrel over the next 6 months. Absolutely, cha-ching is exactly correct. And so, what we're seeing here is, obviously a lot of bullishness on behalf of even some of the larger hedge funds that are out there. But as great as that sounds, let me also tell you what my experience of being an analyst who has absolutely been the ditch digger for 20 years in this market. I got to give you a little warning behind this. Anytime a firm comes out with making a price forecast of $70, $80, something along those lines, it will almost always be followed by an even higher price forecast by other segments of the market. Okay?
Not to be left out, right?
It's because they're setting a psychology is what they're doing. Okay? If Pat, if I was to come out and say my price point, and this is a price point that may be a self-fulfilling prophecy just because of the fact that Goldman Sachs said it, okay? Because everybody's who's interested in oil futures, they're going to dive right into that oil market and say, wow, if Goldman Sachs says it's going to 70, then we need to go. We're at 65 right now. Let's jump the heck in, okay?
That is the classic definition of the self-licking ice cream cone. Am I wrong?
Without a doubt.
You're going, I know how we can drive this.
Okay, but if they really want to achieve $70,
yeah,
somebody else or even them will come out and go, well, wait a minute. I know $75 sounds good.
77 sounds better.
How does 82.50 sound? They're setting that psychology because people want to go, oh, well, if people are already getting in at the 75 level and they think that they've got another $7.50 to go, then it's setting the psychology where those prices can go incrementally higher.
And you know, the driver that we've talked about before is the value of the U.S. currency and the dollar, and how that teeter-totter with the value of the dollar against the price of oil being priced in U.S. dollars is always active and always so undeniably strong.
Well,
so
exactly.
Where's that going to head?
Well, now, over the course of about the last year, you're exactly correct. We have seen some very good strength in the U.S. dollar compared to other currencies around the globe, particularly in Europe, and even against places like, for example, Japan, where their economies have been showing some signs of cracks in the foundation, and you're already starting to hear little murmurs again of more bailouts for countries, just like we saw back in 2008,
With
2009.
Greece, sure.
Exactly,
Greece
and so if that dog begins to hunt again, all right, and has been sort of kind of going down that road, it adds at least perceived strength to the U.S. dollar, but that's been going on for a while. Now, again, going back to the whole premise that markets don't go up forever and they don't go down forever, okay, we're now beginning to see some weakness emerge in the U.S. dollar. And as that weakness begins to emerge further and continue even deeper in the U.S. dollar, then just like you said, Pat.
Yep, it's going to drive it up.
It's that seesaw effect. You've got the dollar on one end, you've got a barrel of crude oil on the other. As the value of the dollar goes lower, crude oil prices will go higher.
If no other forces are in play, that will happen.
That's exactly correct. And so, yeah, you've got situations right now where, obviously the dollar is a little bit of a wild card. And let me tell you another big, major potential catalyst that could send prices higher and has already been a little bit supportive for WTI is the amount of speculative short positions that have been accumulated in oil futures contracts. Whenever you have a psychology that is in the market that says that these prices are going to go lower, then you will begin to see speculators pile in on a short contract. What does that have? What is a short contract? Well, whenever you short something, the investor is thinking that the price of that commodity or underlying equity or whatever the case would be is going to go lower. In other words, you will make money if the price of that commodity or investment actually falls in value, okay? But what happens is when you've already gotten to a point of full saturation down at the bottom, and it doesn't look like we're going to go any lower than where we've been so far,
How do you bail out of that one when
you cover your short position,
right.
okay? And where investors begin to lose money if they're in short positions is if that commodity price begins to take off and really rise fast. Because you got to remember, you're making money on the downside of the market, okay? If prices turn around and start running higher, you're in a losing position. You have to cover. When you cover, you're buying back those positions. When you're buying back those positions, those prices begin rising at a very fast and steady pace. So in combination with everything that we're talking about, in combination with situations like we're seeing over in Venezuela, all right, where oil production is likely to take even a much larger hit, where we're seeing situations where OPEC is likely to continue cuts all the way into the end of 2018 and maybe even beyond, when we're seeing geopolitical tensions over in the Middle East continue, particularly with Iran, all this does is it's all catalysts to lift those oil prices higher. Only thing that we have to be concerned with is what happens here in the United States with the amount of domestic oil production as these oil prices rise, because just like we've seen in recent years, when that production begins to rise at a really rapid pace, it shoots the industry in the foot if they can't find markets for that oil fast enough.
You're watching another episode of the Energy Recon right here on Energy News TV. We're so excited to have you along with us. Remember, when you're wondering where are the oil and gas markets heading, short term, near term, right here, Energy News TV. We'll be back.